Hi guys, it's CryptoBurb Adrian speaking. Welcome to today's Friday webinar. The recession has now been confirmed. It's the second consecutive quarter of negative growth on the GDP side to the United States, which leads the entire global economy into something that we call a recession, where the economy starts contracting. How does that impact Bitcoin? How does that impact stocks? And why recession is actually a good time to invest? Well, we are going to discuss this and more. And if you're ready to hear that, make sure you stay tuned. We are going there right in a second. Hello, everybody. Welcome to the stream. Let me know, guys, if you can hear me, if you can see me well. My name is Adrian CryptoBurb. I'm shooting this straight from Portugal. Love this beautiful scenery out here in Ericeira. This is my place. Love this ocean vibe so much. Beautiful weather. Let me know how the weather is up like in where you are located. I'm really curious about that. And well, hopefully there is no technical issues, and because I've got for you some very interesting insight. Specifically for the recession, but also going well beyond that. If you guys want to hear about this and more, let's just cut it straight to the chase. So first of all, we have now been confirmed to see this official confirmation for something that we know as recession. Recession is a period of economic business cycle where the economy contracts, right? There's never kind of like an ascending, increase in the markets. Markets tend to oscillate, and the economies driven by the markets tend to oscillate as well. So that is because it actually expands, inflects, and contracts, followed by an inflection, followed by another expansion, and so on and so forth. This is like a sine curve model, where you would see the economy really going back and forth between peaks and troughs. Well, if the times are good, the economy is going to make new highs and new lows, just like you would see that in the markets, right? So hopefully, guys, you are very aware that another month, another instance of, consecutive decrease in the GDP, right? Percentage change over quarter. Well, this is really telling you that the economy is contracting, right? This is a technical definition of recession. And funnily enough, the Fed, right ahead of these, Jay Powell's speech release on the FOMC meeting and the 75 basis point rate hike, some people would take it as a little bit of a more dovish. Somehow, I don't understand how that 75 basis points rate hike was dovish. I think it actually confirmed recession. However, the markets reacted positively to it, right? But we are talking about not only 1.6 negative percent on quarter one decrease in the GDP side, but also followed by consecutive minus 0.9%, okay, on the quarterly basis. And again, this had actually been expected to be positive quarter in quarter two. However, despite the positive expectations, we saw deterioration in there. On another part, I'm really happy to announce and to share this good news with you guys, because I officially passed the CMT level 3 exam, and right now I'm in the process of hopefully claiming my CMT title, Chartered Market Technician, which aims to standardize the approach to technical analysis, which is too often too subjective and too underappreciated, too undervalued, too misunderstood. And I will definitely and proudly make my aim and goal to try to popularize technical analysis officially as somebody who is actually backed by some confirmed knowledge and audited externally to deliver some high value insights to you guys. And taking it straight to the merit, let's talk about the industrials, right? The industrials are really pushing forward. We are looking at this instance of a follow through to the upside. I love to see that, because this is exactly what we had to see in order to confirm a bear market rally. Well, what does it mean, the bear market rally? Is this bullish or bearish? Well, that depends on what kind of time horizon you're looking at. So bear market rally is a rally within a bear market. Is bear market bullish? Not necessarily. Is a rally bullish? Yes. Okay. So this is a medium term kind of like a wave up, tied up, basically correcting quite a decent chunk of the what the bear market had lost already, right? So we are talking about the major deterioration coming off the peak, of course, since November, early November last year. And we are looking at the substantial decrease and deterioration on the 200-day average, which is the red curve. Okay, it's declining. 200-day average is declining. This tells you, it defines the long-term trend. The long-term trend is defining this is a bear market. It's confirmed, and it's still until it starts moving up, the bear market resumes. However, this medium-term correction may actually let us see some proper recovery into the resistance area. It's 34,000 points. Okay, and if that happens, well, it's additionally backed by this bullish crossover of a shorter-term average, 20-day average, this green one, over the 50-day average. So the short-term crossed over the medium-term trend, which confirms this willingness of the market to push through, to follow through to the upside. And play some encouraging, I should say, notes and sounds for the rest of the markets. Okay, hope that is somehow clear so far. There is Nelson from Chicago. Hi, what's up from Chicago? Hello from Italy, from Christian. Hi there, Allah. Buongiorno, right? Or following Brad Pitt, my favorite in Glorious Bastards. Buongiorno. Croatia, Darko from Croatia. Love to see it. Tragic Garlic, love the name. Howdy from Zurich. All the best love to you guys in Switzerland out there. Okay, I hope that what I'm saying so far is pretty clear, and that you can still see me well and hear me fine. Please let me know and keep me up to date. By the way, if you're watching that on YouTube, make sure you actually stay notified of the future notes, because throughout the show I'm going to come up with a couple of references to what you're going to hear throughout the week and the next day, so try not to miss out on the pieces of the content we release for you thoroughly throughout the week. So stay notified, hit the subscribe button, smash the likes if you're watching that on YouTube. If not, move over to our YouTube channel. Luckily and happily for you, that's exactly where you're going to get tons of good content. And continuing that aspect, composites. The composite index is actually following through even more and even better. If you compare that, the industrials, okay, are actually, having its pre-final crash peak at around 33 to 50, if you will, while at the same time the composites are already breaching, the previous high area. Okay, so this is an actual, again, breach to the new high, making a higher high and a higher low, following this sort of bullish ascending triangle formation pattern, seeing this perfect rotation and this perfect breakout retest sequence following through to the upside, not only through the local highs, but also through the major highs in June. Okay, this is very promising, and for the for the S&P 500, for the large caps, this is yet to happen, with a follow through over 4200s. If that actually happens, the market is continuing upwards, much stronger on the momentum. It is well backed by this consumer discretionary, which are cyclical stocks driving this kind of I should say, entire positivity and the willingness for the market to pursue. There's some clear underperformance and overall stagnancy on the consumer staples. The energy, however, is coming back up. Okay, it's retracing this entire, the big part of this kind of a crash that happened, in June, retracing almost 50% of the value, coming off the peak of 92.2 for the XLE down to 70 points, almost 65 points, if you will, for the CTF. This tells you of the magnitude. This tells you about the magnitude on the decrease. And you're looking right now at an attempt to break above the medium-term trend, okay? Medium-term average, 50-day average at 77.5, which actually broken through to the upside after strong gap up opening. I would argue that following through to the upside may take it for another leg of a bull market rally for the energy, potentially disturbing for the stocks in the longer run, okay? Then you're looking, of course, at a healthcare, which is, put into stagnation, perhaps a form of this inverse head and shoulders pattern as well. If it actually follows through to the upside, breaking up and retesting this with a rounded bottom retest, somehow this may also add a little bit of the selling pressure to the other markets. We don't want to see actually a rally to the upside, upwards trend, which is led by defensive stocks. Okay, we don't want that. Instead, the technology is what we want to see. The communication services is what we want to see improve. However, if you look at it, it's actually in the stagnation. It's still consolidating, so it's lagging behind. It's not given this bullish trademark, this bullish confirmation, trade confirmation into the upside just yet. Well, the real estate recovering sharply and strongly, and then you would be looking at well, other markets, of course, on top of that. Well, taking a look at the bonds on the yield prices here, the 30-year bond prices, or yield prices, I should say, are actually right there at the headline, at the very neckline of the head and shoulders pattern. I think it's very apparent, right? We do have this left shoulder, this head smashing and picking through, and this right shoulder bounce after previous bouncing off the neckline. It does make sense, so that if you see this deterioration to the downside, this breakdown with a weekly close through the neckline, I would argue that the next stop, based on the measured move and the average support, may be toward 25 basis points here for this TYX, for the 30-year bond yield prices. Okay, and my favorite one is actually 10-year yields. And it is because it's a good proxy right now, and it's kind of like getting a little bit of more sensitivity, towards short-term movements naturally, and that's why you're looking already through this lower low setup and the breakout to the downside with an actual follow-through on that intraday basis. So close the week in 2-3 hours from now, close it below 26, and you're looking at something that is an actual, I would say, intermarket correlated confirmation to the bear market rally. So we want to see the yields coming off, or the yield prices coming off, in the form of this head and shoulders pattern, because if it does, this gives this kind of like a stage and a proper room to the cyclical stocks, and through the proxy of correlation to the Bitcoin and to other cryptos. So I hope it makes sense, everybody. Please hit me up with your questions. I'll try to pick 1 or 2 questions at the very end of the show. So if you're here, make sure you hit the subscribe button, smash the notification likes as well, smash the notification bell, smash the likes, leave some comments with questions, like I said, because even if not on the show, I'll do my best to get you guys some answers to and with my team. So pushing it further, we're looking at this overall performance chart. I would argue that over 200 days, or even if we approximate it to match this year-to-date data, you're looking at 35% leadership from the energy sector, right? And slightly coming up positive utilities. Also, again, like I said, we don't necessarily want to see the bear market rally or any rally whatsoever driven by utilities, driven by defensive stocks. If that happens, well, you're actually losing that this is some form of a trap, some form of a empty kind of like a movement driven on local, short-lived basically basis, right? So we want to avoid seeing that, and instead we love to see cyclical stocks picking up. And you can tell there is this overall, I should say, Staples Healthcare, right? Staples Healthcare are basically within the break-even level year to date so far. Okay, so it's remained somewhat of a more stable, for the year so far. However, we don't want to see it, get closer to the main performer, to the top leader, the energy sector. Okay, if that happens, then year to date, I would argue that we are going to, only have some short-term window. And one of my favorite charts, for discussing the sector rotation and how potentially the stocks may be following or backing up not only the recession itself, but also, I should say, the sector rotation, as in giving you the portfolio management insights. This is a very valuable tool because it tells you and displays 2 axes, and one of them on the vertical side is basically JDK, which is from the author Julius de Kampner. I think he's Dutch, if I'm not mistaken. Great guy. Relative strength momentum. And on the horizontal axis, you're looking at the JDK relative strength ratio. Okay, so it's all benchmarked against the S&P 500, which is right there at the intersection of the axis at 100 and 100 point. Okay, and the very principle of this is that the sectors tend to rotate, that the markets tend to rotate, and you're looking at the leadership and the well leadership, if there's such a word even, you know, to change periodically. And at times, this is very apparent because if the momentum decreases and if the relative strength decreases, okay, then you're looking at the well lagging parts, right? And you would like to be underweight on your portfolio on some lagging assets. You'd like to be overweight based on the for instance, one of the portfolio kind of like models. If you like to be more overweight with the momentum, where the momentum sits, where the winners are, right, to cut the losers short and let the winners run on the leading side. So whatever is in the leading quadrant, more often than not, it stays there. However, the markets tend to rotate, and they tend to rotate, towards the improving through leading. Then, when the steam comes off, you're looking at some form of a weakening, and the cycle closes up, right? So you're looking at the sector rotation right now away clearly, okay, from the dollar. Dollar has already escaped its leading. It stopped leading on a 5-week basis, and instead you're looking at the weakening quadrant right now as the place and location for the dollar. So this tells us that the dollar is losing its previous position on the relative strength and relative momentum basis in favor of the cyclical stocks, right, such as consumer discretionary, like XLY, for the sectors, XLC communication services, and XLK, right? So the ideal case for the bear market rally confirmation would be so that you see and you observe this sector rotation towards of the cyclical stocks, towards the leading quadrant, and the defensive stocks such as XLP, XLU, XLV, or XLB per se a little bit, or dollar, of course, coming and moving to the lagging quadrant. That's what you want to see in order to have this biggest credibility for the bear market rally, to have some sustainable move upwards. Please let me know, guys, if you can hear me, if you can still just fine. We had in the past cases where it kind of like disconnect my mic or something and you wouldn't hear me. So I just really want to make sure that that you're still here with me. And there's Crypto YM saying, hello, everyone. Hi, you just joined. I can tell. That's really good. And well, I'm really, really curious, guys, about the inflation, by the way, right? While I'm waiting for your answers. Now, the inflation is a major threat. However, after an aggressive kind of like rate hiking cycle so far, and the next FOMC in September, there might be some space for easing off a little bit of the inflation, right? There is this discrepancy and an overall lag, I should say, taking period moment after the Fed orders rate hike toward an actual effect, right? So because this economy is a huge giant, kind of like a monstrous, I should say, business, is a monstrous company as a whole, there is this not perpetuity, but there is this continuity of the movement, like that, just like in the physics, right? Once you move an object, it kind of like is not going to stop until there is a force, right, that drags it. So this drag is an actual rate hiking cycle that they started implementing, right? So it takes time until it kind of like stops and slows down. With the economy has slowed down, it's been through an inflection point already. We got this confirmation for a recession and it starts contracting now. So it makes sense to eventually start easing the monetary policy over some time. Perhaps not yet, but eventually there's going to be some bright days ahead as well. So moving on, looking at the dollar chart, right, which is right at the resistance, I should say right through the resistance. This is a very valid chart, right? And not only in 2015 we saw this major breakout and retest followed in 2017 for the dollar index against the basket of other main currencies, basically confirming a 30-year breakout, right, anchored at 1985. But we also saw this month, well, what I would argue a very, very spectacular breakout so far. However, we still have 2-3 days to go for the month, right? And who knows what happens? Because if the week actually closes for the dollar somehow below the resistance, this would commit to a breakout, which is a fail, right? To this failed breakout, as in this coming off with a supply pressure to the downside. Okay, this invalidation of a breakout per se. So, however, and otherwise, if we do actually see this break and confirmation for a monthly close outside 104 points, which is the main resistance, as you could expect, the previous swing highs areas of the consolidation pattern here that dollar had been through, then I would argue we are looking at something that may be potentially more defensive in the near to medium term, right? There's recession means that there is still, I think this nicely summarizes this, right? The recession or the economy is led by the stocks, right? So this being the business, the stock market cycle, when the stocks start crashing, the economy takes some time, usually 6 to 9 months, and starts decreasing as well, right? Starts inflecting. And if I were to pinpoint a point where we are at right now, I would say we are somewhere over here, right? It doesn't necessarily mean, right, the stocks have much to lose, because we've lost already the major part of the market. There might be still, like I said, some bear market rally. However, this is very likely that we still have not escaped the bear market. And if that is so, then we are going to be looking at a set of new lows after this bear market rally. Okay, so be wise about not overspending. This is not a bull market anymore, right? This is not time to be irrationally exuberant about your picks, about your trades, and just spending relentlessly. In fact, the biggest companies, the biggest failure met in the companies globally is because of overspending at the peaks. When the times are good, the companies and the people, the traders, tend to be irrationally exuberant. When they tend to spend too much, they tend to overinvest. And when that happens, the capital expenditures, or so-called capex, basically goes through the roof. And this is the very determinant, the very determination point for which many companies fail and basically go insolvent. This is the reason why many funds go broke. This is the reason why many businesses close and fail, especially in recession. So how does that all impact and connect to Bitcoin, having still a couple of minutes left? Well, historically speaking, we had always seen some positive reaction eventually or off the 200-week average for Bitcoin. Is this going to be the first week ever since breaking the support and following through to the downside towards 17,500? Is this going to be the first week closing over the 200-week average 22,500? It does look so, right? However, we still have 2-3 days to go for the weekly close, so let's not be too early on judging that. However, the first successful close through the 200-week average is likely going to be this cryptocurrency-based confirmation for the bear market rally for Bitcoin, right? So we're still in the bear market. The 50-week average also confirms that. 50-week average is, if you think about that, almost the year average, right? Year, which is technically, again, 52 weeks in a year, right? So many traders would use 52 weeks in a year. Regardless how we look at it, the market is in the downwards trend, right? The recession is there. We had already been through the worst. The Bitcoin had lost and retraced about 75% peak to trough of the entire movement. So typically, we know that Bitcoin tends to return, negative drawdowns, basically somewhere between 80 and 90% historically, to put in the trough, to put in the final bottom. So 75% historically is not necessarily placing that or marking that as a potential bottom. Who knows what happens? Nobody has a crystal ball. I have no idea. Perhaps there is going to be a Martians attack tomorrow, or an asteroid crashing into Earth. The charts are not going to tell you that. The markets are going to react to it, however. So it's about the system robustness that is going to lead you actually out of the major troubles, okay, and saving your portfolio, since adding you big clumps of profits. So that being said, seek successful close through this consolidation period for Bitcoin is likely going to give additional confirmation for Bitcoin to go and retest the previously lost support, which had been tested several times. And it has been tested and validated with subsequent increases. I would argue that the more valid it was, the more important it was. And because it served as a strong support in the past, the the experience shows and the history learns that people would try to anchor and gravitate towards this level, considering this as a potential threat, as a barrier, right? Giving up a little bit of their hopes as we approach $28,000. So that might be the local target, somewhere between $28,000 and $30,000, which is beautiful round number, maybe where we're heading for this bear market rally to kind of like give us a little bit more downside there. Is this going to be an actual case? Nobody knows, myself included. However, what I do know is that we have just got back this bullish tendency, this bullish reclaim with a broken resistance. The bulls are back in control also of my favorite time frame, 12-hour time frame, which supports position trading for the medium term. Medium term is anything between 3 weeks and 3 months officially. Okay, so this is also my time horizon. This is my trend following strategy for the breakouts based on the CTF trailer. This is the CTF trailer which adjusts basically to the volatility, which adjusts to the main breakout levels, validating the trends. It gets chopped a lot in the sideways, taking the win rate down to 30-40% in some extreme cases. However, the payoff is much bigger when the trend tail actually develops. So it is wrong much more often than, let's say, mean trading, mean reversion trading, the range trading, but you get much bigger clumps of profits, which compensate for all the losses lost on the small, basically drawbacks. So here you're looking at an actual confirmation that the bulls are back in charge, and if that helps, they have the upper vote in the market. They hold the upper voice, the upper vote. They are more decisive. They are in control and in charge. And I would argue that as long as they are, this does not necessarily promise, any or guarantee any bull market or any spectacular rally for 500,000% immediately all of a sudden. However, it does tell you that the bulls are back in charge. Okay, they are who rule right now, and they are going to give in a little bit and give out. Right, they're going to let the bears actually take some corrective waves. However, this tells that the stronger tendency is the upwards version. So I'm actually a freshly opened position there for myself with $260,000. To adjust for the 2,000 for the 2% risk on my account. Here's a little bit of a confirmation. Feel free actually to look it up in my private trading channel in our Discord community, and because that's exactly where the majority happens. $260,000 worth with an entry at the next close. But the following close, for instance, the signal was actually broke, right? So in trading, you need very strong discipline, right? It's not only about the profitable system, which in this case is very apparent. The BPRO is actually like hell of an amazing system. It's been co-created and back-tested so many times, and it's actually outperforming with the vast majority of the other indices on the other indicators. So it's a very proven system, which is a composite of many proprietary indicators, saving time and money on basically expensive mistakes, no analysis paralysis. This is exactly why I love it so much. I do what it tells me, and I know because I do have a trust towards it. It's been backtested and proved and evidently confirmed to work so well and outperform the market consistently. This is what we call a robust system, and robustness is actually an equivalent of discipline. So as long as I know, the system that I use is well disciplined, is well robust, is well prepared, and it is, then I may lose 7 times in a row, which I likely will. But then I know that the remaining 3 or 4 times that I'll have are going to be all the clumps of profits coming to compensate for all the losses and make it a hugely profitable deal. So that's why I love it so much. And by the way, you can get a taste of that within our exclusive community. And if you guys want to join us, if you're serious about your money, if you need help trading, if you don't really want to commit to years of studying, if you don't have time, if you, for example, cannot drop out of your 9-to-5 job, and because your family would be at risk, you don't want to really commit to the risks. You can only afford to lose basically what you can afford to lose, right? If you are serious about your knowledge, if you want to continue developing, guys, your insights, then feel free to actually come in and see and try out the Burb Nest exclusive Nest Club premium corners. We're going to have it so much of a ton of of exclusive resources, premium proprietary indicators, market scanners, which save you so much time and help you position yourself stresslessly, and so much more, saving you so much stress, avoiding many times the risk of ruin and severe depression, which many people had not avoided ever since Luna crashed. So if you guys want to get endured, if you want to get more resistant to the market itself, get some nerves in control, get in charge of your own trades, then come and learn. We'll get you everything you need to set you up well, and you're going to be the one to make the decisions. But with the right people, 24/7 support from myself, from my team, you're going to be able to cover this and more. And if you sign up today, you're actually going to get 20% off if you go for the 4 months period. 4 months period is going to be giving you 10% off with cryptocurrency payment and 10% off when accounted versus 4 times monthly. So it is a double deal. It is a double discount. And you can claim it right now on our website, right? I'm going to make sure to put the link on my Twitter to this Nest Club deal. 20% off if paid with crypto for 4 months. You may also go for the monthly. It's not going to be double discount though. So if you guys are ready to take this major step, feel free to go in for it. However, that's not all about that. You always need this discipline, right? There's no get rich quick scheme anywhere. There is no holy grail. There is only discipline. There is only knowledge, education, and learning. We can make it a little bit faster for you though. If you guys want to learn about this and more, make sure you leave some comments, leave your questions. I'll do my best to rush through them along with my team. And I see you guys around, because if you did appreciate this very show for the past 30 minutes discussing Bitcoin, recession, cryptocurrencies, stocks, and so many other markets, how it all combines and all entails all together, and actually to get yourself some more profitable tips, then leave some love in the comments. And I love you all, guys. That's all I've got for you in store today. See you around. God bless you, and I see you next time. Bye-bye.